We want to say welcome once again to our regular attendees of this call, and welcome for the first time to new listeners to the Zacks Quarterly Market Strategy Conference Call. It's a service of Zacks Professional Services Division, and it's a live conference call for first-time attendees. It features Zacks strategists providing their analysis of the latest issues and trends affecting investors, the market, and economy, both globally and here in the U.S. Zacks Chief Equity Strategist and Economist John Blank and Tim Nyland, Managing Director of Zacks Professional Services, will be our panelists today. John is going to help us understand what's going on with our economy at this point in the cycle, and then Tim is going to focus on the structural change taking place in the market as it relates to our economy. So, John, we'll start with you. What does this big picture look like? Are we going through a growth slowdown here or a stalling out process?
Terry, we get a 3.2% print out of the first quarter of GDP, and our models are coming up with 2.8 to 3% for the entire year. So, generally speaking, I think people should remain modestly optimistic about the forecast for 2019. I mean modestly optimistic in the sense that 2.5 real final sales growth was the number baked in to that first quarter GDP growth rate, and 0.7 of it came in through the back door through inventories. So if you go to my next slide, what I'm concerned about here is the inventory gains. This has happened last year and it has happened this year. We have actually a slowdown in consumer spending. That shouldn't be too worrisome, because it was the first quarter and there is winter declines in that number. But the more interesting thing is how we have gotten to 3.5%, even 4% growth numbers on a quarterly basis. A lot of it has been inventory gains. When you put this much turmoil out there, not only trade turmoil, but the Mexican border turmoil, you can see I put in bold a comment in the latest April ISM respondent who said there's growing pressure about supply chain product flow across the southern U.S. border. That's getting inventory accumulation going. So one of the interesting things about this economy when you create this much tension internationally is you actually increase the growth rate quarter on quarter as people build inventories and use inventories, large inventories, as a way to combat the uncertainty. So what you should understand, though, is what is going on here is a decent economy at 2.5% and a lot of global uncertainty, which is another 0.7% for the U.S., but that actually is not good for the non-U.S. world, and the S&P 500, by the way, is exposed to 45% of the non-U.S. world. So in general, that's the bad news, and the good news is that this inventory build is actually hurting the non-U.S. world. Let's go to the next slide. This is the U.S. economy. The gray lines are the recessions we've got all the way back to the 50s. So what I want to show you here is that, in fact, back in the 60s, we did several years below 4% growth, and before we had a recession. And when we did have a recession after that recession, that low growth period, it went up about 2.5%. As I mentioned it to Tim and Adam before this call, when I'm looking at a recession in 2021 on a 200 basis point catch up by the Fed to raise interest rates because the inflation rate got too far ahead, because the wage growth got too far ahead, that is a 2% kind of recession. We talk a lot about when the next recession is, but not what type of one it is. Because before we've had this 2008 thing, and you can see we were at 4.5 and went to 10. That was a 6.5% recession. This is a 2% recession call, much like that 60s period. So first off, it is entirely possible not to get the unemployment rate too much lower than it is now, but for us to just kind of go sideways with a fully employed economy for a couple of years. So the first thing I would tell you about is we have the grounds for believing that we are at full employment in this new kind of economy, that we have solved some problems, but we'll go sideways from here, not down into a recession. Look at Los Angeles, Glendale Metro. I was the deputy chief economist and came out in 2011. You can see what was happening. It was 12.5% unemployment. Now remember, back on the other side beforehand, the U.S. had 10% unemployment. So we were way above the national average. but we reached below 5%, which was our incredible performance for us in 2016. And I just left Los Angeles, moved north because it's too hot. Rents are exploding. The place is actually outperforming to see some of this inflation, particularly in rents right now. It's crazy. And now we're at 4.4%. But as you can see, we've been here for two and a half years. So in the sense that we're leading the economy into this record low unemployment rate, which we have, you got to look back and remember Los Angeles has been a train wreck for many decades. And we had very, very few times when we got below 5%, and now we've been there for 2.5 years. So this is a good example where the state and local areas are actually the metro areas, the big ones, Chicago, Detroit, Los Angeles, and many others in Texas and other places, Arizona, Seattle. All these places are really doing quite well and taking us into that low unemployment rate area. So let's go to the next slide. So worrying about the Fed, watch Fed policy. It's still 1.6% of the Fed growth. Fed's inflation, that's not very high. And that's the thing about that's interesting is we're getting to these low levels with very low inflation. That's largely because we've exported a good deal of our manufacturing out of the United States through trade policy. We're beating ourselves up on that right now. But one of the benefits has been keeping the low inflation rate. That's clearly one of the benefits of exporting some of your manufacturing. Next slide. The yield curve, again, we inverted this time, but again, look at this over time. There's plenty of times on a 210, that's the blue line. Look through the 90s where we were at a very low yield curve and sometimes negative for years. So again, we've touched it. It's gotten people excited. The typical response here is we're going to go along for a year and a half before it actually bites. But the point is, it's more likely this is telling us there's slower growth ahead, particularly outside of the U.S. There may be a recession in a place like Italy, but not in the United States right now. Next one. All right, the leading economic agents. I'll wrap it up on this whole story about the economy. But again, we've been drifting from 2 to 1 for about 2-3 years now. Definitely slowing down the interior growth rate to 2.5% for the U.S. economy. But when you look over history, it's that 1% level that tanks us and gets us all the way to 0. 0.5% would be a big number on this chart, and we just don't see that. The little black line is where you got to worry about a recession in past times that really gets you moving. We're nowhere near that. So point is, not yet, not right now. Next one. All right, I'm going to finish with some interesting other ideas about fiscal policy, which is the Trump policy. It's heterodox, meaning we've never seen it before. It gets beaten up because of that, but there's some interesting things that were not planned. One of the corporate profit tax buyback boom at the end of QE was probably correct. It probably helped the markets. The other is the tariffs are a form of tax hikes. So effectively, he is taxing consumption through tariffing, and that is slowing growth, which is keeping the Fed patient. So again, while we wanted to see the country restrict its budget deficit earlier in the cycle, doing it now actually has a positive effect through the tariffing. So these are not plans. These are not what the purpose of these tools were for. They were for dealing with the trade deficit and dealing with the corporate investment boom. But what they have got us is a decent segue out of QE and a decent way for the Fed to stay lower for longer. And that's what I want you to keep in mind. All right, next slide. I'm going to go quickly through this. I mainly want to leave Tim some time to talk about his slides and the ZRS production of understanding of the markets. But for later on, get into the subject. What we really should be talking about in the United States is our productivity growth decline. As you can see over the last 30 years, particularly in this cycle, manufacturing productivity growth has actually been negative. It's poor. We are not getting anything out of productivity growth. Go to the next one. Look at this. Again, very tepid year-on-year real output changes. So you had an economy growing at 2-3% a year, but your manufacturing real output growth is 1.8. That's sub your own growth. So yes, we're going to a service economy, but this is very poor. Look, even in the 2015, we had negative real manufacturing output growth during a boom. So this is just example A of a problem. Go to the next slide. And so here we have infotech always leading this economy. We all know that story. And since 2007, manufacturing capital intensity has basically gone nowhere. So the big problem with manufacturing, much like agriculture, it's a lot of it's in smaller towns and rural areas. And there's no pick up in manufacturing sector productivity, none to be said. So next slide, please. So this is the story. Right now, the United States has a productivity slowdown, and it's not going away. I'll let you read this later, but the basic point is we have to have productivity gains, and we have to distribute them better in this country right now, and it's just not happening. Next slide is neutral. You can read about this. The measurement error is not likely a case. Next slide is positive, which is the happy scenario is that we're about to turn up productivity growth after a long, long decline, that some of this tightness we're seeing in the economy is going to finally get businesses to put out some things. The best example probably is, as you can read down here, is the potential for driverless cars. That could be transformational and add a ton of productivity in a place like Los Angeles. So again, there's a happy scenario if you think about it, but it's not right now. Next slide. All right, Productivity 101, read this through. Part of the problem is the retiring baby boomers. Next slide. And this is down at the bottom. The main thing I want to point out, and read this later before I hand this over to Tim, but the point is that Brookings did a great study on productivity gains in the United States, and the strongest area for productivity gains will not surprise you. That is San Jose, Silicon Valley. But if you're not in the tech areas or in the energy production areas, you are basically seeing your declines in productivity. Go to the next slide. And this is really only small cities that had major research universities that were not outside of energy and tech saw productivity gains above 1%, which is really low. So the next slide, please, is this is the point that when we think about our politicians talking left or right, how many have talked about productivity solutions for regions that are suffering in the United States? By and large, the tension in the United States politics is about the fact from 2004 to 2015 up to now, only some major areas like Silicon Valley, only the energy production areas, and only small cities with major universities are participating in the growth of the United States. And that's because they can get to productivity solutions that can compete globally and internationally and nationally. The rest of them can't. And we have to solve this problem. This is the focus that should go on right now, not the U.S. trade war. That's displacing the intensity of where the discussion should be. It should be on productivity solutions. And so with that, I'll leave you to read the slides later and get into more of the details. But my basic point is this is the discussion that we need to have as a nation.
So, John, just to clarify, we're in a growth slowdown? Is that what I'm understanding?
We could be, Terry. We're not there right now, but the yield curve, the leading economic indicators, and the Fed staying patient is telling us that, you know, we're basically in an expected 2% growth for real final sales, and that's not going to make anybody happy. The base bottoms up estimates for the S&P 500 for 2019 are 3.4%, which is earnings growth that's not great. But within that is a 4.7% revenue growth rate, which is decent because, you know, again, last year was the tax cut. We can't really compare it to that. But basically what we're trying to get to is realizing year-on-year comps stink, but it's going to be a modestly but slow growth year for the United States.
Okay, thanks. And so, Tim, against that backdrop, you're going to help us now understand, hopefully, how we got to this point and what, in fact, may lead us into the next recession, right?
Absolutely. Absolutely, Terry. Thank you. Yeah, so John's presentation utilized a lot of the macro charts from our Zacks Advisor Tools platform. I'm going to go ahead and shift over to the Zacks research system, and we're going to take a top-down analysis of the market. Take a look at that. This particular yield curve chart is one that I really like. It's one that I've just recently added into Advisor Tools. This is obviously from the Zacks research system platform. if you were to expand the history of this all the way back in the 50s, it literally looks the same prior to every single recession. You can see the recession periods here in gray, and I've highlighted with the red circles the yield conversions that normally begins 1 to 2 years prior to a recession. These points of inflection are very critical, and what you want to note is that that short end of the curve rising to meet that longer term maturity is real each time we are preparing to head into a recession. So these are the indicators that the credit market are sending us. Now, there's a lot of debate obviously going on as to whether this indicator is real. We all know what's going on with global central banks, and they've been pushing yields to it, zero, if not negative, which is obviously forcing, capital over into U.S. markets and keeping our yields low. There's a lot. I mean, we could debate this all day. But the key here is that as of this morning, the market has just sent us another recession indicator, right? So the 10-year did dip against the 3-month T-bill and send us into another inversion this morning. So again, this is something to be aware of. Keep your eye on it. It is real. It's happening. What I want to do now, and you can go to the next slide, Terry, is really take a look at the forward earnings multiple for the S&P 500. We're going to do this a little bit differently because whenever you're trying to get a really good indication of what's going on from a top-down perspective, you got to really pay attention to what biases exist in your underlying numbers. And so what I did with the Zacks research system is I actually took the S&P 500 and I stripped out the cap bias from it. And so what we're actually looking at is an equal weighted S&P 500 composite of a PE based on 1-year forward earnings. And what we're going to be actually looking at here is how we got to this point. And what I mean by that is if you take a look at the multiple expansion that took place from 08 to where we are now, it's really important to understand how this thing could unravel. There's no evidence yet it will, but an understanding is certainly warranted at this point in the cycle. There are basically 2 factors involved in any PE multiple expansion or contraction. We've got macro factors and we've got company-specific factors. So go ahead and, oh, you already hit the next slide. Great. So let's go ahead and set aside the company-specific factors for a minute. We're going to hit on those here. But what I want to show you is that I've got the PE chart that I just had on the prior slide on the top panel here. And again, this is from the ZRS system, the Zacks research system. This is just a 1 to 4 panel chart with the 4th panel suppressed, so it goes to a 3 panel. And what I want you to observe is this strong inverse correlation between forward multiple of the equal weighted composite S&P 500 relative to equity risk premium and the total equity discount rate. Now keep in mind that, when you hear S&P 500, you think to yourself, well, there's really 5 stocks that are, dictating the overall trend in the numbers, and it's, Microsoft, Apple, Google, Amazon, the likes of those mega caps. And the nice thing about being able to equal weight the composite is we've literally stripped that cap bias out. So these relationships are real. They're indicative of an equal weight for all members of the S&P 500. And the neat thing is that I actually took some time this morning. I had some time to run some correlation metrics against both equity risk premium and the total equity discount rate relative to PE. And basically the R squared for the PEF12M to equity risk premium was 0.8, so very good statistical significance, correlated at negative 0.9, and the total equity discount rate even stronger with an R squared at 0.89 and correlation coefficient correlation at negative 0.94. So these are very strong relationships. And they're statistically significant, which is something that you definitely want to pay attention to. So these are the macro factors of influence that got us to where we're at, this PE multiple expansion. Obviously, this is a low interest rate environment, and it supports elevated or expanded PE multiples at this point. So next slide, Terry. So what I want to do now is just kind of take a look at underlying company-specific factors. So we talked about the macro factors. Let's take a look at revenue growth as a company-specific contributing factor to that multiple expansion. And I took a look at the recessionary period to current, again, relative to the S&P 500 equal weight. And you can see that we literally had revenue growth of 50% that translated into 320% returns for the equal weighted average stock in the S&P 500. That's not necessarily the return of the S&P 500. It's the equal weighted average return for a stock in the S&P 500. So a little bit different way to look at it, again, taking out the bias. The neat thing is it's not indexed. So we're taking the 500 as the membership exists today and looking backward, right? So we're not going to have that bias in there. So really, really good indication. So obviously, if we've got a 320% return in the S&P 500, again, trying to explain how we got to where we're at today, you know, how do you get to 320% return with 50% revenue growth? I think that's the question. And where this really stems from is that if you look in the media, you look in the journal, CNBC, you know, about once a week, you'll come across some article that says, you know, the S&P 500 is at risk of a 40% decline. It's possible. And they really don't do a good job of explaining how exactly that could happen. And these are the factors that are going to drive any event that would have a possibility like that to take place. This is how it could happen. So let's go to the next slide. Okay. So this is the really critical slide, and its primary driver of this expansion was net margin. We've actually had earnings growth of 500% over that same time frame. So if you couple, you know, 50% revenue growth against, you know, 500% earnings growth, you've got a 320% average return for the equal weighted stock in the S&P 500, and that's the real driver here, has been net margin. So you've had PE multiples expand based on this low accommodative interest rate environment, coupled with the decline in equity risk premium. At the same time the multiple is expanding, we're throwing more fuel on the fire, because why? We're growing revenues over that same time at 50%, but even better, and you can hit the next slide, is that net margins effectively doubled for the equal weighted average stock in the S&P 500. So just the average company in the S&P 500 has been able to double their net margins since 2009. And notice that in this slide, we're actually well above the median. The median's only about 9%. We're currently sitting at 12%, and you can see that leg up there with the Trump tax cuts as well, obviously having an impact. So this is the big story. We really have to pay attention to margins. We need to pay attention to revenue growth as the company-specific factors that could really turn things around from a valuation perspective. Next slide. So the thing that we worried about in valuation itself is a margin collapse, right? And in fact, we all know that in most cases, margins are very cyclical. So we look to charts like this in the Zacks research system to be our guiding light in helping us determine when we might experience a revenue growth rollover. Keep in mind that that top panel chart is a trailing 12-month revenue chart, but it's transformed into a 1-year percent change series. So we're not looking at absolute revenues on a trailing 12 basis, because it would just be a straight line. What you have to do is transform the series, changing into a 1-year percent change growth rate, and then you'll be able to actually see the periods of slowdown. What's even more important, keep in mind that the way margins work is that they flow down, right? So basically when gross margins slip and operating margins slip, the net margin is impacted. It's kind of like a compounding effect. And the real risk here is obviously the EBIT margin, which is the operating margin, which I also have circled in red. Now, again, keep in mind this is indicative of the equal weighted average S&P 500. This is again speaking to the average company in the S&P 500. Okay, So what we want to do is we want to keep our eyes on declining revenue growth coupled with that operating margin compression. Really what it comes down to is the wage inflation that John Blank was referring to. So let's take a look at the next slide. Okay. Next slide here is just taking a little bit closer look, bringing the number of years down a little bit just to get a little bit better scaling. You can see the trajectory here for the equal weighted average stock in the S&P 500. And when we look at this type of chart, we want to think about this in terms of sustainability. So we've got revenues and revenue growth and operating margins kind of plateauing, and that would be fine if that can be sustained. What we're really worried about is a rollover in those two numbers. So let's go to the next slide. Now we're going to shift gears a little bit and take a look at what everybody looks at, which is the market weighted average. The reason I like to use the equal weighted average, it tends to be a much more conservative measure in terms of valuation. And so if we look at the market weighted S&P 500 composite, you can see that operating margins have already started to roll over, which is a little bit concerning because obviously that could trigger a material decline in net margin if that trend were to continue, even if revenue growth were to stabilize. So if that revenue percent change in the top panel were to continue to stay flat, if operating margin continued to roll over due to wage inflation or some other factor or some other force, then you would see that net margin decline, and that would definitely be a bad thing for PE multiples and equity valuations. Next slide. Taking a look at the forecast revenue growth for the S&P 500, equal weighted, you can see that forecast growth is tapering, as John alluded to. These are just obviously a consensus of all the analysts that are contributing to the underlying companies, and then we roll those up, obviously, to the equal weighted average company in the S&P 500. Next slide. You can see that when we put the cap bias back on, so we basically take a look at the market-weighted S&P 500, that we've actually got forecast revenue growth that has already started to roll over. So the real question is how far revenues will roll over, and when, if ever, will wage inflation begin to compress the operating margin. So, in short, when I spoke with John earlier this week about wage growth, and we tried to put our heads together to determine, what would be the real factor that would have enough scale to put us into another recession. The only thing that John and I could really come up with was it's really wage growth and wage inflation. So if we start to see that number get heated, it would definitely be cause for concern, pushing up prices, eroding margins, and obviously, the Fed at the same time, given PCE and other indicators, would probably have to start raising rates, and then we would get into this downward cycle. So these are the things that we really need to keep our eyes on. And that's what I've got, Terry. Thank you.
All right, Tim, thank you. Unfortunately, time is something that we never seem to have enough of on these calls, so we want to thank our panelists at this point, John Blank and Tim Nyland, and we hope that you found this informative. And if you have any questions regarding our services at all, feel free to email them to zrs@zacks.com. If you'd like copies of John's or Tim's PowerPoint presentations that were featured in today's call, again, the email to request them is zrs@zacks.com. Contact your ZRS representative directly. You could do that, or access them in the GoToWebinar console after the end of the presentation here. In the meantime, thank you for joining us. Feedback is always welcome. In fact, after you close out of this webinar, you're going to be prompted to fill out probably a 1-minute survey. We'd appreciate it if you would take the time to do that, because that helps us to fine-tune these presentations, improve the quality and content for future calls. And as we always say, we'll look forward to the next time we're all together on the call.